Okay, so hello everyone. So we're starting a session on domestic issues with a paper on involvement of MDBs. It's a perfect fit. And it's a bit of a controversial topic, but we do think that it's actually a very important one in the current context. So I'll be setting a bit of a scene and talk about why we should be talking about evolving MDBs, and then Marina will present some of the work we've done on that. The conversion didn't work fine as well, but so that was structured. I mean, all of us know that right now we have a lot of covered debt problems. So we have what I would say is massive sovereign debt crisis in the global south. Of course, we can discuss whether, I mean, IMF would say it's not a debt crisis, but crisis of development or so. But at the end of the day, we have a lot of countries that really are struggling, and we are at a moment where countries around the world really need to invest massively into climate action, into SDGs and all that. So various figures are floating around from the G20 on what the investment needs are. But the reality is that countries are de facto cutting back on all of these investments because they are really struggling to stay afloat, and they're basically trying to avoid sovereign debt defaults at all costs, which means that's cutting their spendings, and as we've described it in a report we put out recently, they're effectively defaulting on development and climate because they're massively underspending in these areas. And that, by the way, is also undermining debt sustainability, because if countries don't invest in climate adaptation resilience, for example, this is making them even more vulnerable, undermining future debt sustainability. So we do need to look into how the critical investment needs of the day can be reconciled with current debt situations, which of course also required us to look more deeply into DSAs and how these critical investment needs are being integrated in DSAs or not so far, and of course also how climate and nature risks are being integrated. So that's kind of the background, and we think that we will have to discuss MDB involvement because for several reasons. The first one is that there's actually a large number of countries, to our calculation, 16 countries that have severe debt problems and that have an outsized exposure to MDB debt. Yeah? So here are 16 countries, and according to an analysis that we put out a couple of months ago, are severely struggling with their debt, and you can see that their debt service, more than half of their debt service is going to MDBs. So, I mean, you know, if Timor-Leste, for example, needs debt restructuring, and you're excluding MDBs, I mean, you know, it's going to be very difficult to have meaningful debt restructuring, but it's writing up the 9% to other creditors, right? And of course, the list is much longer if you also take into account countries that have 30% or whatever of their exposure to MDB. So we need to talk about it. Second, I mean, MDBs basically exist to support development, right? And if debt is a major block to development, we have a problem. And the question is also then, you know, is new financing provided by MDBs, for example, supporting development, or is it just kind of bailing out private creditors, for example? And one issue that's been, of course, very critical in the discussions we've had over the last years is the fair burden sharing. So what's fair comparability of treatment? And we all know that China has had particular issues with the involvement or non-involvement in MDBs. Those 7 countries, Paris Club has been very straightforward, saying we're not going to discuss MDB involvement. And China have been saying, well, why are our development banks treated differently? And a lot of complicated issues, but this non-involvement of MDBs certainly has been a very contentious point and really holding back debt restructuring. So we should be looking at it. And then the final point, quickly, if we actually look at internal rules of MDBs, and especially, for example, if you take IDA, IDA has a so-called traffic light system. So they look at the IMF World Bank classifications of which countries are in debt distress, have high, moderate, low risk, and so on. And so they cannot give, they have to give 100% grants to those that are in the critical categories, which basically means that as the number of countries, either eligible countries that have, in the red or yellow categories, the business model doesn't really work because they have to give out more grants. So here we can see how grant elements have been increasing a lot, and going forward, this is effectively undermining IDA's business model. And so we are very much aware that we need strong MDBs. We need MDBs to do much more going forward. They need to have preferred creditor status and so on, but we need to see how they can be involved in debt relief where needed. And Marina will tell you everything about how we think about this.
So I think a quick key question now today, and in the previous panel we were discussing comparability of treatment, right? It is a question of how much the MDBs should be responsible for the sharing, taking into account that they have a very, very high level of grants. So compare with the private sector that actually price default. So is that fair that MDBs and in private sector take the same haircut, for instance? So this is something that we will look at. So I think that defining the burden sharing is a key component. And as we discussed it earlier, so we not only have different products when we look in that restructuring process, we have lending conditions that are different, maturity, grace period, collateralization, so on and so forth. And also we have lenders with different mandates, with different restrictions. So how do you go about? Our key argument is that we need a simple rule when you go to comparability of treatment. It's very difficult to account for everything, but a key measure would be the cost of lending, because cost of lending can be a proxy of his burden and expenses, right? So what we did, we take into account that the private sector, for instance, they do charge a risk premium according to default risk, according to the risk of developing countries. So this is actually a graph from the Bank of America, so it's not mine. They calculated, they know this, and they show this to their clients. But we know that when actually bondholders go to that negotiation, they actually take a smaller haircut compared with official creditors and others. So the case of Zambia is a case in point. Although they charged at the beginning about 80% of a coupon, pricing the risk of default, when they actually came to give that relief, the ex-post return of the bonds were actually in the second agreement was 58%. Now with the final agreement is a little bit less, but they're still receiving a lot of ex-post return, although they price ex-ante default. So what we're proposing, and this is exactly the opposite of all private sectors. So we know that IDA is very concessional. IDA actually provides to countries in that distress a small volume of lending compared to the private sector, but they have a very high level of grant element. But grant element is not only from multilateral development banks and IDA. China gives also grant elements. Other official bilateral also give, and of course, Paris Club also give. They all gives grant elements in different levels. So we actually can account of how much debt relief each creditor can give, taking into account the X and lending prices. So this is what we did for the 16 countries that we identified. We account that if they go with 64% of overall debt relief, which would be a high level, considering that these countries need to mobilize, financing for development, for climate. So if you consider a high level of debt relief, it will mean, for instance, the IDA would be accounted for only 4.3 billion, which is relatively, it's actually smaller compared to the volume of grant elements they are giving every year. So actually, it's a good deal not only for the creditors, but for IDA itself and for multilateral development banks that they have clients that are, with better debt sustainability. So we calculate then the distribution based on the interest rate here. And I must say maybe we should have said this in the introduction. The 16 countries were identified by a debt sustainability analysis that we did in our last report this year. We did an enhanced debt sustainability analysis where we included investments in development and climate to see which countries can actually support this kind of investments. And we found that out of all the DSA countries, 66 countries in our sample, 47 countries need debt relief. And out of these 47 countries, 16 countries, the participation of the MPBs will be crucial. So here, I won't go to those numbers now, but what is key to understand when you look to comparability of treatment is that if you need to put a very high level of overall debt relief, in our case, we calculated for 64%, which is the average during the HIPC initiative. If we consider, if you do not consider the interest rate that creditors provide ex ante, and if you do not include the MDBs in the calculation, basically the private sector, China, other bilateral creditors in Paris Club, they basically need to cancel their debt to bring an overall debt sustainability to these countries, to give a debt relief of 64%. So in some cases, including NDBs in the calculation will allow that you don't cancel the debt for some other creditors. Finally, I will end up with the final conclusions that for which policies, we know that NDBs has preferred credit status. We want to protect their business model going forward. So which options are actually available for backup NDB losses? There are a few. Some of them is based on history. So if we look to the HIPC initiative, NDBs were backup based on internal resources. So revenues from IBRD was channeled to IDA. And also with donor contributions. I think now we are in a key moment because IDA is being replenishment. And we could, for instance, not only replenish IDA, but replenish the fund, the debt relief fund that was used during HIPC, and then enable the NDBs to give debt relief at this moment. Another key policy is regarding the IMF, because a lot of countries are actually getting indebted to the IMF. So replenishing the catastrophe containment relief trust, which has been completely used during COVID, which is like, this is the fund that the IMF uses to forgive payments. And we could actually use part of gold resales to replenish this fund and support developing countries at this moment. So apart from replenishing funds and donor contributions and internal resources from these institutions, which I must say would be relatively small compared to the size of these institutions, there is also new opportunities. Thinking about if you have new SDR insurances, some countries could use it to repay their debts to these institutions that are prescribed holders. If you have a financial transaction taxes in the future, this could be channeled. the MDBs are also bigger, they will have more capacity to manage these countries that are not being able to, that should receive some relief. So having a bigger MDB would support this. So of course, not necessarily there are trade-offs. Well, I will go to last slide now, but there are trade-offs between having, directly debt relief and more financing. We can discuss this during the Q&A, but there are trade-offs between Erce directly and more financing from the MDBs from the countries. Just to finalize, I think beyond MDB participation, I think we need a very broad reform of the international financial system. We need the reform of the DSA. We need a system that allows preemptive debt relief so we don't build vulnerabilities. We need a reform of the common framework. And key, we need to expand the size of the international financial architecture. We need more SDR assurances. We need more IMF resources to allow better restructuring. We need more financing from the MDBs. So that relief is part of a broader picture and a broader reform. So I end up here. Thank you very much. Sorry.
Next, we have Godfred Bokpin, Ghana's novel domestic debt exchange program, lessons for the global community.
Okay, thank you very much. Good morning, everyone. I'm sure you heard a lot about Ghana. We are mentioned along the same line as Lankan. Here, and unfortunately, we sit together.
My presentation is followed.
All right, so Ghana has restructured its debt about six times in our history. It's the first time that we actually restructuring our domestic debt. So it's for us, it's novel. We haven't seen it before. We were comfortable imposing haircut on external creditors, but this time around we are internalizing it. And it hasn't been that easy for us. The whole issue started way before COVID, even though our government tended to blame everything on COVID. But before COVID, the vulnerabilities were there. If you look at Ghana, the proportion of interest payments over total expenditure has run almost at the same level as compensation. But we can compare that to other countries like Cote d'Ivoire, right, which is very low. You can compare that to Rwanda, which is very low, but Ghana was way up there before COVID, right? So, and then you realize that as the debts started climbing up, the trade-off was actually capital expenditure. And so as the debt levels started rising, the interest payments started rising, then CAPEX, right, the redistribution effect of government funding started coming down and got to a point, and actually after satisfying interest payment and compensation of employees, the country didn't have anything for growth enhancing spending effectively. So we realized that. But then, even though the total debt was rising, in the case of Ghana, there was no way we could achieve debt sustainability without looking at the domestic debt. Because the domestic debt was actually taking more than 65% of the total interest cost. Okay, so in the case of Ghana, the problem wasn't really the external debt. In terms of the liquidity constraint, the problem was more of the domestic debt. So if you see how much the domestic debt was taking, right, almost 3 times that of the external debt. And therefore, it wasn't surprising to us when the IMF made the domestic debt restructuring a prior action, right? That we needed to do that before the staff level agreement will actually go to the board for approval. So we had a short time to be able to do that, and the data supports that. Okay. So in terms of the drivers of the debt, right, the primary balance has been key, but then the depreciation of the local currency was also a big factor, right? So when we market to market in terms of the external debt, okay, the depreciation manifests explicitly in debt formation, and it was a big issue for us as a country. So you can see Ghana here, almost an outlier in the sub-Saharan African zone, okay, and it's simply because, yes, COVID here, but COVID didn't affect only Ghana, right? Okay, so you can see the average for low-income developing countries, and then also Southern Africa average, but that of Ghana was way up here, and it's simply because of the 2020 election, right? So which also happened the same year as COVID was. year. So we actually took advantage of COVID and overspent in order to win over the electorate. And that is why Ghana's own was a bit more on the other side, right? And government found a nice way of blaming everything on COVID, right? So everything as though the virus only originated from Ghana. Okay, so that was it. So the issue is that, I mean, this is common now because the debt composition has also changed. But the bigger issue for us, and here I'll speak for a lot of low-income developing countries, has to do with the interest cost, right? And so, which was a big issue for us. So you can see this, my friend here is here, and then followed by Ghana. So after my presentation, you will come, okay? So the issue was that, but look at the average cost at which Germany borrows from the same markets, 1.5, US 3.1, Asia 6.5, Latin America 7.7, but Africa is 11.6. That's difficult to understand, right? And more so, these are more expensive debt, right? But this expensive debt that Africa takes, they actually do invest it in development projects to enhance the cash flow generation capacity of the economy. All of that goes actually into consumption, right? And part of it also to subsidize interest payments. So it's not so difficult to realize that these countries will struggle to service their debt because really they didn't invest this in the growth enhancing area. So again, so if you look at in terms of the solvency, maybe it's not so much of an issue, but liquidity is a big issue, right? And then in the medium to long term, it tells you what the whole issue will be. So you can look at Zambia. They were here a couple of hours ago, right? And then look at Nigeria. Debt to GDP ratio is a bit low, but the servicing cost is very high. And then you can look at that for Ghana. But what is showing here is also accounting more from hidden debts, right? So in the case of Ghana, we had a lot of hidden debts, okay, which wasn't known to the international community. So we had debts that were hidden in state-owned enterprises, but they all had cost implications. Apart from that, we also had exchange arrangements. Also, Nigeria is also in there between the government and the central bank in terms of deficit financing, which essentially is another form of debt. But until the IMF came to the fore, all these debts were treated as off-balance sheets. Okay, so it wasn't giving us the overall picture, but then with the fund coming on board, everything became clearer. So as a medium debt carrying country, our debt to GDP ratio in present value terms should not be more than 55%. This is the IMF threshold, right? Using a discount rate of 5%. Then in terms of the liquidity measure, this is the benchmark, right? So the proportion of the debt servicing, external debt servicing to revenue should not be more than 18%. But after they applied the debt sustainability analysis, this was the conclusion for Ghana. Okay, this was the conclusion for Ghana. So our debt to GDP ratio in present value terms came to 109% of GDP when we needed to be at 55%, right? And that is, the margin is just too wide. Okay, so that meant that the IMF wasn't going to lend to us because we are in debt unsustainability level. So what was the way out? We had run out of options, and the only option left for the country was to go to the IMF. And the prescription then was that, okay, in order for us to qualify for the program, then we have to take comprehensive steps to restructure our debts. Okay, what were those steps? So the burden of adjustment then has to do with fiscal, which will go through the budget, and the fiscal alone will not be enough to restore debt sustainability. Because if we have to do the fiscal alone, then the primary surplus we need to record on annual basis should not be less than 12% of GDP. Then you know that it's just like asking fish to climb the tree, right? It's not going to be possible. So the burden of adjustment has to be shared between fiscal adjustment, then so fiscal adjustment was supposed to bring the debt from 109% to 81%. And then between 81% and 72%, the domestic debt exchange was to contribute that. Then from 81% to 72%, from 72% to 55% will come from external debt restructuring. This is the burden sharing that the IMF apportioned for us. So that meant that the domestic restructuring is very key. right, in narrowing the gap. All right, so when we take the total debt, the external debt, and then the domestic debt, of course, the earlier presenter mentioned something that I was also going to talk about. So the total external debt and the cutoff date was December 2022. The total external debt was $30.5 billion. Out of this, the multilateral debt was $8.8 billion. And interestingly, the IMF that was preaching burden sharing excluded their debt. So the multilateral debt works up to $8.8 billion. That was excluded. And then they were putting pressure on external bilateral, which is just $5.4 billion. So really, the IMF and the World Bank wanted to solve our problem. The only way to do it is to also include your debt, right? So that when you preach haircuts, you also see how it feels like. So, so you have excluded your debt, and you are putting pressure on China and the others. They keep on taking haircuts, but you have excluded yours. And is that huge, right? Is that huge compared to this? And within this, the Chinese component, our exposure to China is not as high as that of Zambia and the others. In the case of Ghana, our exposure to China was just $1.9 billion, right? So it's really, in the scheme of things, China wasn't a problem to Ghana, right? We could actually skip China and talk about their sustainability, because and that wouldn't be a big issue, actually, for us as a country. So that's how we're looking at it. And that the issue really has to do with this, right? And then the Eurobond, which was $14.6 billion. So our exposure to the Eurobond market was very high. But the interesting thing is that to date, we are still asking Ghana government, the government of Ghana, what have they used this money for? Right? We can't see it, right? But the good thing is that, and I mean, of course, the geopolitics and all of that did not favor that. But if you talk to people in Ghana and a lot of African countries, they will tell you that they celebrated the Chinese debt because they're underlining infrastructure. Okay, they're underlining infrastructure. So if you pick the $1.9 billion Chinese debt, there is infrastructure, right? That is actually generating cash flow. But then when you analyze this, there is no underlying assets. Because and you know the reason? The reason is that the Eurobond investors are only interested in lending to the government. They have no post-lending monitoring mechanism. Okay, so government shows up during the roadshow, present a balance sheet to the creditors, the investors, and assure them that the country is credible. And then they lend to the government comes and throws a kinky party. That they've been so successful. I have 5 minutes, I'll finish very soon, right? And then after that, there's no accountability and the rest of it. So this is where the issues are. Then the domestic debt, look at the haircut. So in terms of the old bonds had average coupon, these were from the banks of 19.1%. The new bonds had a coupon rate of 9.1. And then so it was a combination of coupon haircut and then maturity reprofiling. So the average maturity was 3.8 years. It was extended to 8.3 years and all of that. But the biggest haircut was actually imposed on the central bank, right? Because the original domestic debt framework, there were a lot of pushback. And because we were working with the DSA framework and the government didn't get exactly what they wanted from all of this, they then decided to sacrifice the balance sheet of the central bank, okay? And so the central bank took a haircut of almost 50% on principal, right? And that led to a huge loss on the books of the central bank. That would take them more than 30 years to recover. So that's essentially what we did. Now, apart from here, what we call here Cocoa Bill and the rest of them are actually hidden debt that were with Cocoa Board and then other state-owned enterprises, ESLA and the rest of them. So the official debt was much lower than what eventually came out when the IMF applied the debt sustainability framework. Okay, so the whole issue was to drag down the interest rate because the domestic debt cost was high. So government attempted that somewhere April 2023, but it didn't work. The rate actually went up. And right now the treasury bill rate is up there and it doesn't suggest that. So if you look at the financial system of the country and how they are regulated, actually there are some kind of transmission mechanism across the various segments of the market. So you have pension that have investment in almost the banks and the rest of them. So right now the discussion is how do we rebuild our financial system? And we ended up setting up a fund, which we call the Financial Sector Fund. The World Bank is contributing to it. So on one hand, we applied the haircut that created a problem and then set up a fund now independent to come and resolve that problem. So, and the bigger issue for us in Ghana is that our domestic debt restructuring is just kicking the can down the lane, right? So it's the debt clustering will happen between 2027 and 2028, and there is no indication that the country will be in a position to settle the debt when they mature at that level. Okay, so I've made some prescriptions. The biggest issue for us right now in Ghana is illegal mining, which has taken over everything. Thank you.
From one interesting case to another. Next we have Chayu.
Can you put it on the presentation? Sorry, what? Can you put it on presentation?
Optimising domestic debt restructuring, the Sri Lankan case.
Oh. That's the only thing that I had to close it on. No, just if you go back to it. Okay, so I'm always struck by the fact that Sri Lanka and Ghana is quite similar, but I'll end up with slightly different conclusions than corporates. So there is a little bit of diversity. So this presentation and the paper that we did here is based off some sort of work that we did since about early 2022 at the firm that I work at. So both myself and Thilina work at Frontier, and we did this paper on top of that work, collaboration with Umesh from University of Colombo, and we're talking about how Sri Lanka's case can act as indications and lessons to understand how domestic debt restructuring can or cannot work in other cases. So there's a lot of content in this presentation. We started out with one question, we ended up with at least three. There's probably 3 to 4 papers here, so I'll try to kind of keep it short. So let's answer any questions afterwards. So I will talk through what Sri Lanka's domestic debt optimization was, what the impacts of it, and could it have been any different, and I will just tie them to a few key takeaways in the end. So what Sri Lanka's domestic debt optimization was, I'm sure many of you know some context, so I'll just give a very quick historical indicator of some of the very specific points that might be important for the presentation itself. Very classic twin debt story in Sri Lanka's case. So current account was in persistent external deficit, you finance that through external debt. Fiscal domestically gain persistent deficit, you finance both external and domestic debt. You had external shock on COVID on the external side, and on the domestic side, we had a massive tax cut situation in 2019 that took a bad fiscal deficit and absolutely worsened it. And both of these contexts then led to external and domestic debt pressures, which then of course led to the crisis and the adjustment that Sri Lanka's economy has been going through. But on Sri Lanka's debt, it's not simply split into foreign currency and local currency, and that did complicate some of the points within the debt restructuring itself. So I won't focus on all of it, but mostly on the fact that this is external debt by jurisdiction. Most of it is, of course, just regular old external debt, but a significant chunk of Sri Lanka's Eurobonds are held by domestic credit. So definitionally, that does come under some form of domestic debt. By jurisdiction, domestic debt, most of it is LKR, but we also have a significant chunk that is actually FX denominated as well. So Sri Lanka's domestic debt has FX debt, Sri Lanka's external debt has debt held by local credit, and that complicated a big chunk of this problem. So I'll get into some of how that tied into Sri Lanka's context and made those decisions a little bit harder to make. So what Sri Lanka's domestic debt optimization looked like? We call it an optimization just to pretend like it wasn't a default, but I don't know why we did that. In fact, yeah, no, I won't get into that later. Okay, so the optimization included both Sri Lanka's foreign currency and local currency debt. So across credit. So the first thing that was restructured was Sri Lanka's debt held by the central bank. So that was a provisional advance, some kind of overdraft, as well as T-bill, short-term debt held by the central bank. So this is essentially past monetized debt that was just held by the central bank. And I'll talk about this, but it is essentially debt that was already a problem, but it's held by the central bank. It's an accounting problem at this point. So it's not particularly important, but it helps on the accounting ratios themselves. We then had a significant chunk of Sri Lanka's FX denominated domestic debt also restructured formally as part of Sri Lanka's domestic debt restructuring. And the most controversial part was that the treasury bond, the long-term bonds held by Sri Lanka's superannuation funds, was also restructured. What actually was part of this domestic debt restructuring and what actually happened here ended up being that you are talking about a little bit more than 50% of Sri Lanka's domestic debt overall being restructured formally as part of the domestic debt optimization. In addition to that, like I said, the Eurobonds held domestic, they are also effectively being restructured. There's also some additional SOE debt, guaranteed debt that is also effectively domestic that is being restructured outside of this perimeter as well. Some of it has happened, some of it is in progress, some of it may never happen, but there is some sort of addition to these numbers as well. So most of the domestic debt optimization in Sri Lanka's context was about adjusting maturities. I'll get into why that was the case, but first, what actually ended up happening. So for the central bank's debt, for the treasury bills and the provisional advances, there should be another bracket closing here. These were converted to long-term step-down T-bonds, as well as a few remaining T-bills for some monetary policy purposes. So this was, again, in Sri Lanka's context, a pretty significant hit onto the central bank's books. But again, it's a central bank, its books are in rupees, it can print it if it wants to, no one cares. I can. The FX debt was converted to long-term floating rate T-bonds, and this was one of the first times, not the first, but one of the first times that Sri Lanka had a sizable chunk of floating rate local bonds. So this is again something new, but it wasn't a very large component of Sri Lanka's domestic debt, the SLDPs. The rest of the foreign currency debt was, but it's been restructured a slightly different way that I won't get into here because of some additional complexities. So the controversy, like I said, was on the treasury bonds held by the superannuation funds. These were converted to long-term step-down treasury bond, where the interest rate of the coupon of the newly restructured instruments were somewhere roughly around the average coupon already held by the superannuation fund, but significantly lower than interest rate market rate at that point. So why did Sri Lanka decide to optimize its domestic debt at all? So this is from an investor presentation, but also a leaked presentation by the cabinet of the governor. Colombo is a small place, you can't hide it. So what it shows is that in Sri Lanka's context, we had 4 IMF targets: our debt stock, our program period financing gap, and then the FX debt servicing. And then the critical one for this is Sri Lanka's gross financing needs. 27 to 32, I don't know how you can even forecast gross financing needs multiple years into the future, but apparently you can. So fiscal consolidation alone does not hit any of your targets. If you have fiscal and external restructuring, you reach these 3, but not your gross financing needs. And then the government, at least the government, probably the IMF as well, say that if you do all 3 of these, then you do reach all your targets and emissions. The local treasury bond component was, like I said, the most controversial, and that is what I will focus on most of the next 14 or so minutes I have. No, 9 or so minutes I have. So this is what really affected the gross financing need reduction. So the central bank's account being restructured actually had led to most of the gross financing needs reduction over 2027, 2032. Mostly because we're talking about the central bank holding short-term debt. So you keep rolling it over, it just expands massively, it compounds. The foreign currency rate adjusted for slightly less than this, but what these 2 alone did was brought Sri Lanka's gross financing needs compared to this 13% number to 13.2%. So you just need to get it the 0.2% down, which you get by doing this on the superannuation fund. So again, I have my own thoughts on whether you need to care about 0.2% of GDP of something you can forecast 5 years down the line, 2 election cycles down the way, but I don't decide this. So what were the actual impacts of the Sri Lanka's domestic debt optimization? So first looking at the real flows of cash, and here I'm using the term real in the inflation adjusted sense. So this is what the principal maturity of Sri Lanka's T-bond stock, how it changed as a result of the domestic debt optimization on the superannuation funds and on the foreign currency, the SLDPs as well. So from 2023 to 2026, T-bond principal payments were forecasted to fall every year. So, and then from 2027 to 32, roughly the same, but slightly lower overall. And then significantly rise from 33 on. So basically you're taking maturities here and pushing them over there. But it's not just about the principal. So I looked at this, the idea from this from one of Robin Wiggles' first read, so props to him for that. But again, what is Sri Lanka's risk-free reinvestment rate? What is the discount rate that we need to take? And that was a big part of the conversation about it. and what appropriate coupon rates to have for the restructured instruments. So, and that is a question because, and what we are showing here is the secondary market rate for Sri Lanka's 8 to 10 year treasury bonds, the local treasury bonds. We saw massive volatility in Sri Lanka's rates. You saw them moving up 1,000 basis points before the crisis, and then massive volatility across. So at this point, one question was, how do you discount Sri Lanka's domestic debt restructuring? Do you take the long-term average of the past, which is about 12% at its best, or do you take the fact that it had actually been falling from, say 20% average down to 9% average? What on earth would you take? You take the highest point there, you take the lowest point there, no idea what was to be done. The central bank's approach, and at least I don't know if it's right to call it central bank's approach, but at least the approach that was published by the government took 12% as one of the long-term averages and 9% as one of the long-term averages, which is in line with what we saw in the few years before Sri Lanka's crisis, before COVID as well. But again, that was at the point where global rates were also at its lowest. Sri Lanka's long-term interest rates before that were significantly high. So then this was questioned. The credibility of Sri Lanka's disinflation process at this point was also at question. So will that happen? Will that not? All of that was factors we were considering. And it's also the fact that when you have a DDO or not impacts the process of interest rate and impacts the counterfactuals themselves. Because if you have the idea behind having the domestic debt optimization is that, look, you can then end up in a situation of low rates because your debt costs are lower, which reduces the probability of the domestic debt distress. But if you don't have it, you actually have a higher probability, so you have a higher rates expectation. But both of these processes can actually feed into each other. You can end up there and you can end up here, and as a result end up here. Or you can end up here and as a result end up here. And these are two completely different counterfactuals. So choosing between these for us is a question that there is no real answer. So what we try to do is to figure out how you discount Sri Lanka's future rates or how you don't do it. We took two scenarios to kind of assume this. One for a DDO scenario and one for a no DDO scenario, what Sri Lanka's long-term risk-free rate could be, what long-term inflation could be, and therefore what the real rate would be. So we took 9% long-term rate for a DDO, long-term inflation at 6% here, real rate at 3, here 15, 8, and 7. These are all assumptions, but don't worry too much about it. I'll show why none of these matters anyway. So what this shows is for one of the biggest superannuation fund, the one that composes most of the debt, what the real value of their bond portfolio would look like if you take either of those two scenarios. Effectively, you end up in a position from 23 to 2038 onwards. You're roughly going at par. Of course, you can take little points here and say one is higher than the other, but you're roughly at par if you take these choices. But again, like I said, why the point doesn't matter, these are just particular assumptions. If you change these assumptions around, you can get completely different scenarios. So what I'm showing here is, here, if you take a DDO scenario at 9, 15, and 17, and a no DDO scenario discount at 17, 15, and 9, you can figure out a way to show that it was either a massive gain for the superannuation fund or a massive loss. But what did end up happening was that Sri Lanka did end up drawing a little bit of a short end of the maturity six, what I called it. In that, because Sri Lanka's, no, this has gotten in the French, this was not intentional. Sri Lanka's T-bond markets did end up, because T-bond markets were locked up and there was a lot of uncertainty, maturities were shortening, our T-bill stock rose absolutely dramatically. From end 2022 to end 2023, it rose more than double, despite inflation during that point not being very significant. And I think a similar thing happened in Ghana as well. Effectively, the problem is you try to push some of your maturities, but your debt stock, in particular short-term debt stock, rose. And this, I think, reverse some of the GFNDA. So since I have about 2 to 3 minutes, I will run through some of the slides slightly faster. So faster than this. Sri Lanka's DDO could have been different. Could we have seen a narrower DDO? The problem in Sri Lanka's context, like I said, is because part of external debt is also held domestically, so not really possible. But not necessarily possible, not necessarily real. The problem, like I said, about 70% government security holding of the local banking system is in FX terms. So you're effectively already restructuring. So the point is, can you then see the net benefit of that or not? It's a bit complicated in Sri Lanka's context because we need to assume some sort of additional impairments on the bank's balance sheet, but we're not entirely sure how that will work. So a wide FX restructuring can reduce your financing needs. It will have high impairments. Problem is, Sri Lanka also has a lot of second order effects due to the way the FX positions, the open position, the swaps in those contexts are. Which banks hold it? None of that is fully clear in the kind of public data that we have. So we know it will at least weaken some of the FX sheets of the state bank. So there is an extra cost, but does it outweigh any potential benefits? It's a question I'm leaving open because I don't have the answer for this, but it is very much a question that you have to mention by context. The wider idea of the state banks, just I don't think they can handle it. I will rather very quickly do this point, the fact that we have the state banks are already requiring capital injection. And the fact that it's likely, whatever DDO that happens, is likely to have additional second order, third order impacts, rising NPLs, rising delinquencies, and the fact that collateral is affected and the like. So what this is, so this is a kind of a Laffer curve example. Is from a paper that was there a year or two ago. What I'm showing here very simply, and I won't explain it in too much detail, the fact that at varied NPV haircuts that are possible on the bonds, you might not really end up with a very significant net debt relief as a result of doing a wider DDO. It might not be one that makes a lot of sense. Could you have had an earlier DDO? And this is one point that I mentioned, Sri Lanka's gross financings are likely to have increased. So what I'm showing here is one very specific point of that, which is Sri Lanka's interest costs in 2023 and 2024. And IMF program were these numbers. By end 2023, the central bank's data and its projection were high. And this, 1 minute left. This results in a difference of about 500 billion, roughly around this point. The IMF and the central bank both acknowledge that this is as a result of some additional domestic debt interest payments, even though the fact that local yields have fallen. So what this chart shows in green is GFN and IMF program request. In red, what happens if you take that 500 billion across 23 and 24, add it on top of the GFN, and just completely just roll it at par. You don't meet your GFN target in that kind of context. Of course, this is not what ends up happening in reality, but this is the kind of one way that we can forecast the fact that the added interest cost worsens GFN. What's left for Sri Lanka's domestic debt, our yields have fallen dramatically. So this has helped significantly some of the costs, but domestic debt is still quite high. T-bill stock, excluding the central banks, is still at about 15% of GDP. It is a massive cost for the economy. It has to be something that remains to be dealt with. So I will end up with two takeaways. One is the fact that domestic debt structures are complicated things. I don't think it is a externality there. It is an internal factor of what the domestic debt restructuring is, because they happen in context of widely ranging counterfactuals in domestic markets. A few here as well, but they are basically going to some of the points that I made. So I'll end with this one, where we're talking about the fact that the second order effects on market maturities is very critical. And that is again something I think is internal into the context. So stock flow adjustments need to be looked at. Earlier can help, but it might not necessarily be always possible practically. So I'll end with this slide again. I think it's a complex problem, so it requires probably a complex solution.
Thank you for the tour. Okay. Let's see. Last but not least, sovereign defaults at home and abroad. We have Mattia, Osvaldo.
Okay, so thank you for having me here. Today I'm going to present this joint work with Aitor and Enrico, who are in the room, which I think actually fits very nicely at the end of this session. And this goes, of course, without saying that the usual disclaimer applies. So what we have observed over the last decades has been like a growing role for a domestic market for government debt, which of course resulted in larger involvement of domestic debt into default and restructuring events. There are currently countries undertaking or that they already analyze restructuring processes both under and outside the umbrella of the common framework. We just heard the cases of Ghana and Sri Lanka. And this is quite relevant because actually there is a very limited systematic understanding of the differences of default and restructuring when we talk about sovereign debt that is issued in the domestic market, domestically, and sovereign debt is actually issued in foreign markets, so externally. There are, in fact, like very important trade-offs that should be taken into account when a government needs to decide whether to default either domestically or externally. And you see, like on the one hand, you have the so-called local advantage. So extraction domestic debt is relatively easier. But on the other hand, you need to consider domestic debt is the backbone of the domestic financial system, and it's also a pillar for political stability. So there are also like important drawbacks that need to be taken into account. So what do we do in this paper? We compare the macro financial, political, and geopolitical environments that are actually surrounding domestic and external defaults. How do we do that? So we start by taking into account the two state-of-the-art data sets that are used when studying the sovereign defaults. So of course, we take Multilateral, where they focus on external debt defaults. And then we take the data set Aitor, Enrico, and myself put together for domestic default events. Before merging the two, actually, we need to do some data work in order to make the two data sets comparable among them. So first of all, we extend the Multilateral in order to cover the last decade of events affecting external debt. And then actually also we verified that all the default episodes existing in Multilateral, they actually satisfy the market of issuance definition that matches our data set in order to have the two exactly comparable. Importantly, also, like, we remove from our data set the episodes involving deposit freezes, because you see, like, there is no a specific comparable term in Multilateral. So what else is put together, we actually compare the years where a sovereign is in a default status, either domestically or externally, to the other existing years. And as I said before, we're going to focus here on macro financial, banking crisis, currency crisis, politics, geopolitics. We have a data set that goes from the 80s to 2019, annual frequency. As a sample, we cover all the existing countries in the world for which there are actually data available. So we go from advanced economies to developing countries. And as a econometric approach, we're going to use a simple OLS and a Prodigy. So now we can start with the first set of results. We can start actually pointing out some similarities. So we can see, like, external and both, so both external and domestic default tend to happen in periods with low economic growth. And in the second column, you can see also with a high level of public debt. But then if we look at the third column, actually, we can point out already, like, a first important difference. That is, the external defaults tend to happen during a strong period of fiscal adjustment. Then, second set of results, what can we get from this table? So first important message is that external defaults tend to happen during periods of strong external adjustment. You can see, like, first column with increase in net export. The second column, we can point out the fact that actually the outflows, let's say the reduction in foreign capital inflows is actually twice as big as the one that you can observe in case of domestic default. Second message that is really, like, specific to domestic default is that domestic defaults tend to happen during periods of credit crunch, being this coefficient extremely large and also, like, extremely significant. And also in this case, we can conclude, like, pointing out to a similarity that actually both domestic and external default tend to go hand in hand with the banking crisis. Now, what about inflation? So this is a question that we keep receiving. So in order to answer to this question, we take here, like, two definitions of hyperinflation episode. The first one comes from Reinhard Rogoff, where basically hyperinflation, a period of hyperinflation is identified in cases of growth in the price level above 500% year over year. And then, like, a second definition, actually, we look at what's happening in Argentina. So we have, like, 250% increase in the price level, and we take it here as a kind of alternative definition. So first lesson also from this slide is that high inflation is not actually a substitute for domestic default, because as you can see here, actually domestic defaults tend to happen in the period of hyperinflation. Now, second extremely important message is also, like, the high inflation is as likely as like during external default. And this actually goes through, we can say, an exchange rate channel. So if we look at the third column, we report the results when we look at currency crisis. So this one taken from Reinhard and Rogov. And actually, like looking at this column helps us understanding that high inflation happens during external default because of the pressure that you can see on the exchange rate. Now, looking at the political context, also here there are very nice results that we can discuss about. So we start with the first column, of course, and we can see how both defaults tend to happen during periods of high political instability. But then actually, if we look at the second column, we can see how elections are twice as likely during domestic defaults. It's actually something that we learned before while listening to the presentation on Ghana. And then, like third column, we can see how radical governments, so meaning like governments with a left orientation, are often in power during periods of external default. Now, last set of results, very current, but also this one very interesting messages. So first column, we can see how like countries receiving money from the IMF are actually kind of prioritizing the repayment of external debt at the expense of domestic debt. So, I mean, you know, this is something that can be very easily linked to the lending to area policy of the IMF. So there is a very nice message here. Then a second set of results, we can see how countries actually receiving official debt relief tend to be more likely to default on external debt. And also in this case, there is a very clear connection to the comparability of treatment. So now, just to recap the results, we've seen how the environment actually surrounding both domestic and external defaults tend to differ quite substantially. Here we report the main difference we just discussed. So domestic defaults are associated with credit crunches. External restructuring tend to happen during period of fiscal consolidation and also external adjustment. Also, again, like external default are less likely when the political orientation of the government is on the right spectrum. And last but not least, domestic defaults are more likely to trigger political election. Now, last slide on the policy lessons. So we have also seen how both IMF and Paris Club policies tend to interfere with the process of defaulting on either domestic or external debt. So here there is a very nice message, and maybe, I don't know, we can discuss a little bit more. So because IMF arrears, lending to arrear policy actually seem to incentivize domestic default in order to prioritize the repayment of external debt. Another important policy lesson is that, of course, the macro framework that is used for the DSA should take into account these differences we just pointed out. Financial loops we've seen they are keys. So the ongoing revision of the low-income country DSA should take into account these differences, and revisions, of course, should be extended also to the monthly DSA. And thank you.
Your time budget too. Great. Good thought there. Okay, so since we have a full room here, I'll just begin by offering a few opening questions, open the discussion, and then we'll have our broader questions and discussions, because I think these papers speak to each other a lot. Clearly, we see similarities across them, and then two papers that bring the cases together in a broader context. And what comes out of these papers, I think, is clear that we see that the process of restructuring is clearly a technical, difficult, complicated one with a lot of financial constraints and rule-based, but it's also fundamentally a political process. I say this as a professor of political science. I suppose my bias here is what I'm seeing. The question of power mattering. So I think analytically in many of these papers, some of the puzzles that come out, such as, why does a divergence from fair treatment and what is fair treatment? Why are costs imposed on some domestic actors rather than others? Who's included and who's not? Why are governments paying more? Why are SOEs accomplishing? The power and the leverage to allocate the burden and the cost is something that could be made a bit more explicit in these by articulating who are the actors shaping this. The multilaterals IMF can exclude its own debt, right? Why? What is their position in the hierarchy? So if you clarify in a lot of these, who are the actors? What are their goals? The resources and constraints to achieve it. So the power and the leverage is something that can be articulated quite clearly, as well as what are their goals? And crucially, what are the time horizons? So multilaterals, we would tend to think have a longer time horizon because they're not going away. But as we see in the first paper, they have investors as well. So they're thinking of their shape of their own decisions and objectives in terms of allocating I guess costs, and part of this restructuring has a lot to do with what's going on behind the scenes. And I think that comes out quite clearly and could be incorporated also into understanding why the multilaterals do what they do. Especially as well, this framework can be used to understand why are the governments are privileging either different domestic actors, or pensions, and superannuation funds come out clearly in this as well. Clearly, go-go votes and governments or grandparents are both a sympathetic and important political actor, right? But these are also important economic actors as well in the domestic economy. So I really appreciated in the Picarelli paper that the role of ideology in government is explicitly incorporated. But here I think also more articulation of what is it that how ideology would shape it. And we have other dimensions here, nationalist governments, populism as well, that shapes a lot of these. So the politics behind this are important in terms of understanding power, but at the same time, the institutions, the domestic institutions, we see this very clearly in the Ghana case, right? How is it that they can get the loan and throw a kegger party? Why? And it's not just the domestic institutions constraining the government, but why is there with the Euro bonds not a post-lending monitoring, right? So there are multi-level games going on here. And who's leveraging, why I said that the central bank of Ghana took the biggest haircut, right? So we can think a little bit more in understanding the sort of frustrating parts of these cases, the dilemmas, if we think a bit more about the power and the leverage and explicitly about the actors and the constraints. At the same time, the time horizon. So this came out quite nicely in a couple of papers in terms of the electoral cycle in all three of those. That the time horizon under which governments are acting in terms of the political business cycle, the electoral cycle, it's done quite nicely explicitly in the Picarelli paper, but the Ghana 2020 election also we see this. And in Sri Lanka, you're predicting over electoral cycles, which says something in terms of more explicitly bringing that in. I'll stop by just pointing out two other factors or questions for all the papers in terms of can this framework and the study of this bring in two really important intertemporal dilemmas that both shape that mean we have short-term constraints on things that we need long-term investments for. The first is climate mitigation. The climate crisis, we're talking about costs imposed now, exactly at a time when these governments need to invest in the technologies that will pay off in terms of long-term growth and social welfare. The second is investing in human capital, right? Because the human capital in the developing countries of capturing the demographic dividend means that they're at the moment they're being constrained is when again they need to spend on exactly what in the long term will pay off for escaping and avoiding a perpetuation of that cycle. So it'd be interesting to understand the extent to which these factors are explicitly discussed in restructuring or optimization processes to avoid that future debt trap. So those are my comments for the papers, broadly sort of to open the discussion, but I'll begin right now, I guess, by taking some questions. First, Candace, I was there in fact.
So I have few comments, questions for the Aitor, on the Multilateral Government Banks. So what is this? So I need to read the paper. It's very important what you're doing. You know, like you speak about the cost of lending as a way to qualify who should contribute more or less. But I think that necessarily that needs to be mixed with other terms of the loan, most importantly the maturity. Like maybe the interest rate is larger, but if I'm offering a 50 years loan, then I'm offering a lot actually. Then there is this issue like the trade-off. You went to the trade-off between like so a haircut or more financing. I would go for more financing. I would go for more financing and get rid of whatever the traffic light says, because that is the debtor imposition argument in like private bankruptcies, right? So if you have one of the existing creditors that is willing to provide fresh credit that is enlarged the payment for everybody, that fresh credit should be seen. So I think that there is a parallel there. I don't know if you want to use it, and then like can I just finish so then it's so long. I mean, what is governance? Because I mean, I'm only for relieving, I'm giving grants and everything, but actually, like we did one thing okay, in the development bank, and we look at what happens when you get the restructurings going forward, depending on the quality of governance in the country. And if you have very poor governance, nothing will happen, right? You just get more debt again, you don't grow more, and that's that. So I think that, I mean, like there is something missing here that is governance.
Thank you. I'm going to collect a few questions before we let the, okay, the next section. Okay.
Thank you. I would like for Ghana and Sri Lanka, the share of non-resident investors, because I read this when was the Ghana restructuring was going on, that the issue if the restructure involved or not foreign investors. They need to know the share of foreign investors in the total debt, and if how the restructuring, that if they were involved in the South. Thank you.
You're next.
Thanks. So my question primarily to both the and Chayu. So it's the parliamentary or wider political process, because I now through this domestic debt restructuring and Ghana had hung parliament. To my knowledge, I mean, I don't think there was any specific act on the domestic debt restructuring. It was kind of wound up with a budget. I don't know what the parliamentary majority was in Sri Lanka, but clearly it was a period of significant political turmoil, like the elections in both countries at the end of the year, but it's quite a high likelihood that there'll be a shift in political power to potentially, a party that doesn't feel they have any ownership of the actual restructuring. So is that anything people looked at, and also if Mattia looked at it in a wider context of the amount of sort of legal bills being passed in Parliament, as you mentioned there is often a lot of political turbulence and elections during these events. Thank you.
Question for Ulrich and Marina. On your potential menu of options to finance the NDB haircut, you mentioned increasing the equity of NDB. Do you suggest that they should actually write off the loans by having a higher equity? And then what that would do to the preferred equity status? And then the second question is wonder whether you are taking NDB as a group, and whether you do not see a trend towards differentiating between different NDBs, and whether this is something that you could consider. I'm thinking in particular of the IMF lending areas policies and their criteria for what would be creditors excluded that may not apply equally to all NDBs.
If it's okay with the others, I'll continue to take some more so that we imagine you want to hear as much as you can from the room.
So just two quick questions. The first one is for Marina. How do you define your fair COT? It's like bouncing back on Aitor's question, because to me it's also evident that the common ground is the grant element, which is going to summarize both the cost of lending, maturity, and many more elements. So how do you get your fair comparability of treatment? Where do you get it from? And the question is for Mattia. Have you tried, so when you compare the normal years versus the crisis years, did you try to exclude from the normal years the period just before and just after the default? Because we know that countries tend to often bounce back quite well in some cases, or that was just a technical question. Thank you.
So I have a question for William Marina. How do you think World Bank partially guaranteed loans? Do you have data about that?
My question's on the very first slide of the session, where you showed the really high share of debt service to entities in Western countries. So I think the first two countries in them are going to more or less depend on high-risk countries. So I haven't checked them. If they became high-risk countries, they wouldn't get the share of, sorry?
Yeah, sorry.
They're not countries at high risk of debt expressed.
According to IMF.
They're not according to IMF. And if according to IMF, they became that, their share in, NDP, that wouldn't grow because they would only get grants. So I think it would be interesting to see how that interacts with that sustainability assessments, whether the system actually changes a lot of years for countries that are actually likely to go.
Sorry, well, yeah, if you look at the stock of emerging market debt, 25 trillion dollars today, only 4 trillion is hard currency, the rest is local currency debt. And generally investors view it as the biggest movement in the last 2 decades, where we're viewing that the local currency funding is much less vulnerable than external funding. Now, from a perspective of a country, in your view, which default is less disruptive, a local currency default or an external default? And could one argue that actually the policy could be, and the debt sustainability perhaps would be less about the stock and the cost of debt, but more perhaps having, let's say, bigger share of local debt should be less disruptive from a country perspective, even though more political in terms of restructuring, than going down the external route.
Thanks so much for this presentation. My question is for Godfred on the Ghana case, but I'd be curious in Sri Lanka as well. So, the IMF DSA made clear that restructuring would be necessary, and therefore a domestic restructuring is likely hard. But I'm wondering, it's a very sensitive question what the distribution of burden sharing is going to be between domestic and external, and what your sense is about the extent of agency that the government had to say this much is going to come from domestic versus this much is going to come from external, and to what extent there was a negotiated feature. My sense is that the fund is saying that is the debtor's choice. So I'm wondering whether you have a sense of
Okay, we'll have a pause then, if you guys can remember all of your questions. We'll go again in the reverse order that we presented, so. Mattia?
Okay, so I can start. So the question on the visa, well, yes, because on the other hand, the market conditions is really like intrinsically connected to the law. So whatever we look at, it's related to like parliamentary fee that was approved first of all. Yes, for the regarding the question on the exclusions of the years before and after, no, we didn't do. Yes, it's something like that easy.
So on Sri Lanka's non-resident holdings, we did have some substantial amount back prior to 2018, but with the game break there, a lot of it exited, and whatever left also exited post 2019. So I think by the time the restructuring happened, we had about I think 0.1, 0.2% of GDP non-resident holdings of total response. It rose a little after that, fell a little after, but nothing very significant in any case. Then on Sri Lanka, I think the other few questions together on the kind of local agency, the politics of the situations, as well as on your point on the kind of political dynamic therein. So I think in Sri Lanka's context, and it's related to the fact that in Sri Lanka's context, most of the domestic debt was held directly or indirectly by the state. So the central bank has a substantial amount. The EPF, which is the largest superannuation fund, has about 40% of the long-term bonds. Most of the rest of the bonds were held by the three largest state banks, three largest state banks, two of which are commercial banks, one of them is a specialized bank. The private sector only held about, I think, about 10-20% of bonds. So the decisions therein, there is some level of independence for all three of those actors outside of the government, or the treasury itself. But that independence is going to be a little limited in the context of the kind of distress that the country was going through. And that tied into the kind of the political situation they're in the country, because we ended up in a situation where Sri Lanka traditionally had a center-right party and a center-left party running. Absolutely hating each other. During this time, it was the center-left latest iteration in parliament, but president was from the center-right party, and they all got together, a whole new situation in Sri Lanka. No one knows how that's going to work, and that ties into the fact that whatever electoral process that come up is also very uncertain. So in Sri Lanka's context, the domestic debt restructuring did go through parliament, because like the weekend session that they put in place went through parliament, went through all the processes in time. But the government had a majority, but it was a majority that was voted in a very different context. So this question there of the power and the agency very much come into play, where who really made that decision. For me, one point is that because the outside of, let's say, the superannuation funds, again, like I said, there was only 0.2% of kind of a margin that we're trying to meet 4 or 5 years down the line. That's at least one election cycle, probably 2 down the line. So for me, you're dancing around a very small decimal point, and that is not really the kind of thing. Because if you're talking about whether you're getting 13% or 20%, that's a significant difference. But you're talking about 13 or 13.2, then and for me, the cost onto the debtor there, or the creditor there, was not very significant problem. But the fact that that decision made led to other costs therein. And that ties into the point on I think the external versus domestic default. For me, I would say in Sri Lanka's context, at least the external debt restructure default would have been far less disruptive than a domestic default would have been, simply because the domestic default would have completely shut down the financial system therein. And that would have been far more disruptive to local systems. And so in Sri Lanka's context in particular, we haven't really had that. We haven't defaulted before. We haven't had very large banking crisis until like 1800. So not something the Sri Lanka system is geared for. I would say external defaults are less disruptive for, at least for Sri Lanka in that context, but also given all the other dynamics at play.
Okay, thank you. In the case of Ghana, the non-resident holding wasn't that much, but was an issue for us. I think the total was around $1.6 billion. And that was restructured as part of the domestic debts. So I lean towards his position on the external versus the domestic in terms of disruptive nature. We would have preferred that the haircuts were loaded on the external investors. I mean, and I'm being selfish here. Forgive me, because the issue is that we are working hard to build our domestic markets. And this kind of disruption is not good for building confidence. And right now it's already showing, because we've worked so hard in the last 30 years, as you rightly said, to increase participation in the domestic market, savings mobilization and all of that. And this domestic debt has essentially central back by 30 years back. And again, it was the same consideration in the case of Zambia. So Zambia at the beginning decided to exclude the domestic debt because they wanted to preserve the stability of the domestic debt. So, because that's the backbone of the government. Right? As for the external market, it can shut out at any time, but the domestic market needs to be open for the government to control it. Right? So we would prefer that we preserve the domestic debt. But we all got along because we realized that even the domestic debt component, and especially the fiscal cost of servicing that, there was no way Ghana could go the way of Zambia and exclude the domestic debt. We needed to treat that. So we agree. In the case of Ghana, it didn't go to parliament. If the government didn't have the courage of taking it to parliament because it was the parliament. Okay, so the whole thing was to do it off. And the biggest opposition party had threatened that they will review when it comes to power, but I don't think it's something they are going to do. So it's just to create it. So we didn't go to parliament. And then the other bit is that There was an issue about how we agreed on those parameters. All these things were discussed and agreed during the staff level discussion. So at the time that the country reached staff level agreement, the GSA framework had been agreed and the burden sharing had been set out. So initially, the drive was to preserve the balance sheet of the central bank. So the original debt exchange memorandum that was announced, if the banks had accepted that, few banks would have survived. Okay, so there were a lot of pushback here and there, and it was revised 3 times. Okay, so the final deal that got settled was less burdensome to the participating banks, which means that there was then a gap that needed to be closed. And that gap will only be closed by sacrificing the balance sheet of the central bank. So that was what they did in order to. So at the end, the original memorandum that they shared would have translated to almost 80% of NPV losses. Okay, and quite different from Sri Lanka, the domestic debt were largely in the hands of private sector. Banks, regional banks, international banks, and domestic banks, and then also pensions, and then individuals. So for us, the balance sheet effect was real, and the state banks were not that smart in that discussion. I think the other bit was, I think I've covered all of them. The real issue right now is sustainability. So because the international market has been shut on the country, the only medium now is treasury bill, money market, and that itself has been rising. So I think their concern is whether with the domestic debt exchange we will not end up with a zero-sum game, if not negative, right? Because if you look at the way government is borrowing from the domestic market, it's still the cost is very high. Okay, so that is where we are, and also the reprofiling that the government did has a bit of political element. But to some people, it looks as though the government is on its way out. So they were kicking the can down the lane, okay, and shifting the repayment burden maybe to the next government. Okay, to the next government. So essentially what they did was to buy a 2-year grace period of not servicing debt, not doing anything, but then 2025, 2026, it kicks in strong. Okay, and probably our understanding is that the next government is here we are. Yeah.
I will begin by the interest rate question, if it's a good party, and how to come from maturity. So in this exercise, we actually look at the grant element, which includes not only the interest rate, but the maturity. So it accounts for both. And then it gives, when you look to the grant element, you can see interest rate and maturity. So on the question of the DSA and that some countries that are there are not considering now in that distress. The selection that we showed is based on enhanced debt sustainability that we did. The exercise that we did in the last report, we measure in 5 years if developing countries actually invested on how much they should be investing in SDGs, what is going to happen. And we see like a lot of countries that are considered medium, they very quickly hit the thresholds. So this is a new sample. The last year report we did, we only looked to countries considered now as in high distress or in distress or in high probability. So this is a different exercise. So I think we need to have like look forward-looking exercise, not only now. That's the justification for this specific sample of countries. On the question if we could differentiate between entities, I think we could. We saw when we calculated the exercise that it's quite different between different entities. So it could be possible, it's feasible. When you look to this kind of information, it's public data, would allow you to qualify. When you look at nominal present value that people usually want to do calculation, it's very difficult to do because it's not an information that's public. But when you look at grant elements, it's public information and we could calculate with more accurate words. On the question of debt relief and size, I think there are 2 elements on this. First, if NPVs are larger, they are going to have more revenues, more profitability, and they could use a part of this to support countries that are in that distress. So this is one way. The other side is that according to S&P, it's not me, it's a credit rating agency. They calculated how much arrears NDBs could have without affecting their preferred credit status. And they show that actually NDBs, they have some space. Some of them have like 44% higher level that they could bring now. Some of them have like 80 times higher level of arrears they could have it now. So I think preferred credit status is important, but I think there are leeway and there are leeway sometimes even recognizing by the credit agencies themselves. So that's one point, especially the countries that we are looking, they are very small. Like actually in relation to the portfolio of MDBs, their claims are quite small. Finally, where we took the calculations from. And first, thank you for our colleagues from FPL. I think there are two, I think we recognize 3 papers that are working with the comparability of treatment. The first one is from Lazard that actually, I don't know if there is someone from Lazard here. This is a very good paper that they compare different types of how to calculate comparability of treatment. I think it's maybe too legalese and some people don't get it, but they are actually hinting to the fact that calculation based on nominal value instead of net present value, it's a good way to go. And when you look to nominal present value, the public sector does not subsidize the private sector, which occurs when you look to net present value. Our colleagues from FDL, they calculated, they also have a calculation on fair comparability of treatment. And Brendan was someone that helped me with this approach. I think the key differences between our reports is that first, we are also considering not only the possibility of MDBs to give more financing, but also a haircut, and also that we consider the private sector with a negative net element. So, but I think that these are the 3 papers that are talking about this kind of approach. So would you like to say anything?
You kind of noted just on the point from Aitor regarding the cost and maturity. I would like to say, I mean, Marina already said that makes that both in, but there's also highly correlated. I mean, MDBs, for example, provide lower cost finance, but also they provide long-term finance, and private creditors provide more short-term and high interest rates. So there is actually a very high correlation on that one. On the MDBs, indeed, we don't distinguish, and you know that may be a next step, but we're still fighting for the general case. And yesterday we heard about DDEP indeed having quite different kind of operations from other MDBs, but yeah. So with the MDB equity, of course, we don't want to touch that, but increasing MDB equity will enable MDBs to do more, and we do want them to do more, but it can also free some of the precautionary balances. And then one question I think Marina did not address was the partial guarantees. So we don't kind of address this, but I mean, my take on that is a guarantee and should be honored. And I think the treatment of World Bank's partial guarantee in the Ghana restructuring was rather problematic because I mean, I personally would argue that we need much more. We need to work much more with guarantees from the NDBs and DFIs. So that did not set exactly a very good precedent, but it's nothing that we're actually doing. Thank you.
Right, we started a bit late, so we're finishing a bit late, but I want to thank all of our authors for truly excellent papers and wonderful questions from the audience, and I will let everyone go break for lunch now. Thank you very much.